This is Alan Bush with the Daily Financial Forecast for Tuesday, October 11th. Starting out with the stock index futures, we are under some pressure this morning. First of all, in the overnight trade, there was weakness as a result of Evans of the Chicago Fed talking about the possibility of raising interest rates. We're thinking that possibly in December there could be a rate increase, but in any event, an additional hawkish comment from another Fed official putting pressure on the indices, and in fact that seems to be the dominant influence in all of the financial markets today. Also, we did have some weaker than expected corporate earnings that adding to some of the pressure, and one weaker than anticipated economic report. So prices lower. However, I think that we will find some support this morning. Ultimately, I think that we will see some recovery later this afternoon. Nothing has changed in our long-term view. Still feel that even if the Fed does raise rates in December or early next year, that rates are low enough to sustain the bull market. So long-term, it still appears that the trend toward higher prices will remain, and we would expect a new round of highs. I don't know if we could see them later this year, but next year, new highs are likely for all of the major indices. Now, moving over to the currencies, prospects of tighter credit from the Fed supporting the dollar, with the dollar index advancing now to a new high. In fact, this is now at an 11-week new high for the dollar index. So interest rate differentials, while supporting the dollar, putting pressure on most other currencies, especially the European currencies. Even the euro is lower in spite of news that we did have some better than expected economic reports out of the Eurozone. Additional pressure in the pound as the European Union applies more pressure to the UK, with the UK planning for an early Brexit. In fact, the plan is now for potentially a March 2017 exit. Also, we are seeing the Canadian dollar and the Australian dollar lower as crude oil prices a bit weaker, and of course interest rate differentials are negative. So longer term, we do feel that the dollar index will probably continue to remain firm, as the Fed is still the only major central bank that is on track to raise interest rates either later this year or next year. Now, moving over to the interest rate futures markets, new lows for the move yesterday in the bonds as prospects of tighter credit from the Fed loom. Some pressure again today across the board. Also, we do feel that inflation, though not talked about much elsewhere, will ultimately be the prime driver taking the interest rate futures markets lower, especially at the long end of the curve, the 30-year bonds, which is more susceptible to inflation prospects than elsewhere in the curve. So nothing changing in our view, and the interest rate markets look for lower, especially for the 30-year bonds. And I think this is a trend that will probably continue all this year and well into next year. Now, the gold and silver under some pressure as the Fed remains hawkish. But if we are right in our thinking that inflation is coming back slowly, we admit now, but gradually accelerating, that will ultimately be the fundamental that rescues the gold and silver. So with some pressure recently on the precious metals, I think we'll build a base. Ultimately, we will work higher for both gold and silver. So nothing is changing as far as the long-term outlook. The bull market that started around the beginning of the year is still intact and will continue once this base is built. So good trading, everyone. Once again, remember, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.